Today we're going to cover bonds and bond valuation. All right, a bond is just a fancy IOU. It has a face amount, say 10,000, an interest rate, we'll use 8%, and a maturity date, and we'll say 30 years from now. The reason we use bonds is because frequently we need to finance a very large project. If I'm going to borrow $100,000 and I can't pay it back to the bank, I'm in trouble. If I borrow $500 million from the bank and I can't pay it back, the bank is in trouble. So at some point, projects are way too expensive for one bank to handle, or way too risky. One time, I was able to put together a loan of about $60 million for a company that actually was pretty risky. And a lot of the banks didn't want to touch it at all. But I was able to convince 4 different banks to all pitch in and take a little bit of risk. And we were able to work that out. But some projects, like building a new jet engine manufacturing plant, building a nuclear power plant, financing the U.S. government, financing major waterworks projects and dams, those can run $1 billion or $2 billion. Even if we're going to build a casino in Vegas these days, those run $1 billion. So no bank can expose itself to that type of risk. So what we do is we issue bonds. And basically they're individual bonds in amounts that range from $500 at a low. Some will be like $500. Some will be $2,000. Some will be $10,000 or $25,000. The most common bonds bought by individuals are between $10,000 and $25,000. We'll also have bonds that are $1 million each, or even some that are $10 million each. And you're thinking, well, who in their right mind has $10 million laying around to buy this bond? Well, the mutual fund companies who have hundreds of millions and billions of dollars in bonds. Large insurance carriers like Transamerica, AIG, AAA, they have billions of dollars in reserves waiting for the next hurricane or earthquake or a huge fire to come through and wipe a whole bunch of stuff out. So if I'm an individual and I want to buy bonds, I'm probably buying like a $10,000 bond or maybe a $5,000 bond. If I am an insurance carrier and I'm going to buy $25 million of this $1 billion bond offering, do I want all of that in $2,000 bonds? No, I would have a cabinet full of bonds. And I have to track them all individually. I've got to have serial numbers. I get interest rates paid on those things. No, I would rather have 2 or 3 $10 million bonds and maybe a slew of $1 million bonds so that I have very few. Instead of having a whole file cabinet full of bonds, I've just got one file folder in there. And I have to track a lot less. So it becomes very, very efficient. Also, most typically, if I am going to issue, say, $1 billion in bonds, all right, that's an awful lot of money. If I'm going to issue $1 billion in bonds, typically as a company, I'm not going to have them all mature at the same time. 2 reasons for that. One, it's just dangerous for me to have this massive amount of debt come due in the exact day. That's a bad idea. The other is, if I dump $1 billion worth of bonds on the market all at one maturity date, I am going to flood the market. I'm going to have massive supply. Too much supply creates drops in prices, and then I will net less money for my bond offering. So what I'll do is I'll issue what's called a serial bond. In other words, I'll issue bonds in a series. And I'll have a series of different maturity dates. I'm going to go to a bond market maker, and I'm going to ask them, hey, where's the most demand? What years? And they might go out, do an analysis, and say, you know what? There's some demand at 10 years, 20, 25. There's a insurance carrier out there right now we're going to place a whole bunch of stuff with that they want 28 years, and they want $100 million at 28 years to fit their portfolio. They call these guys all the time. They're going to also call Fidelity and Vanguard and ask them what they want. And then maybe we got some 30-year bonds, and we got some 40-year bonds. And so by spreading this out, we don't flood the market with any one date, and then hopefully we get our yields much higher. So we're issuing these bonds, and now how do these bonds work? To figure out how much money I get for this bond, I take 8%, which is called the coupon rate, and I multiply it by the face value. 8% of $10,000 equals $800. I am going to get paid $800 every single year for 30 years. $30 years from now, I will get back my face value, which is $10,000. Once we figure out this coupon rate and take the 8% times the 10,000 to get how much interest we're being paid, this number is now irrelevant. We no longer use it for any calculation. In fact, an awful lot of people, about 15-20% of the class, is going to use this in too many different calculations, and they're going to miss an awful lot. This coupon rate, the reason we call it a coupon rate is because at one time there were bonds, and they were called bearer bonds. Bearer bonds were whoever owns that bond has the right to collect the interest. And they actually had coupons that were on the side of the bond. And they paid interest every 6 months. And so you would just cut off a coupon when the interest came due, mail it to the company, and they would mail you back a check. The Internal Revenue Service hated these kinds of bonds. And the reason that they hated these bonds is it was very, very hard for them to track and tax these bonds. Because I could own this bond, and maybe I'm in the 50% tax rate. I give one of these coupons or two of these coupons to my daughter who's off at school. She cashes them. She pays her tax rate of about 5% and keeps the money. And the U.S. Treasury then misses out on income. And so not a lot of these exist anymore. In fact, if you watch movies and a terrorist is getting paid off with $25 million or $100 million, more likely than not, they open up a briefcase and it's full of bearer bonds, because whoever bears them has the right to them. Now what they have are what are called registered bonds. In other words, the bond has a registration number. You register with the company, giving them your name, address, and Social Security number. And when the interest payments come due, they send you a check, and they inform the Internal Revenue Service that you got paid a dividend so you can get taxed, which isn't necessarily fun. Okay, So how do we figure out the value of a bond? Bonds go up and down in value every single day, the same as stocks go up and down in value every single day. So let's say you bought this bond, an 8% bond with a $10,000 face value, so you're getting paid $800 a year. 2 weeks later, another bond comes out with the exact same risk profile as your bond. But this bond pays 10% and it matures in 30 years. Well, this bond, 10% of 10,000 is $1,000. So you paid $10,000 for your bond. New bonds that cost $10,000 pay $1,000 in interest every single year. Yours pays only $800 in interest every single year. Is your bond worth more or less than $10,000? It's going to be worth less because these pay $1,000. Yours only pays $800. You're going to have to do what's called discounting. You're going to have to discount this. We're going to sell the bond for less than $10,000. Because who wants this bond? Does it have any value? Is it worth $1,000? Certainly it's worth $1,000. If I bought this for $1,000 and got $800 a year return, I'm looking at an 80% rate of return. I would love to have this bond at $1,000. So it's certainly worth $1,000. It's worth $2,000. It's worth $4,000. It's worth more than $6,000. It's not worth $10,000. It's less than $9,900, less than $9,800. We can actually, using time value of money, calculate exactly how much this bond is worth. Interest rates might move the other direction. Instead of the new bonds coming out at 10%, maybe they'll come out at 6%. 6% coupon rate times a $10,000 face value is $600. So you bought your bond for $10,000 and get $800 a year. All the new bonds at $10,000 pay only $6,000, so they get $600. So someone comes to you and says, hey, tell you what, I know you just recently bought a bond, maybe you want your money back. How about I buy this bond from you for $10,000? You paid $10,000, maybe you got a year's worth of interest, now I'll give you $10,000. And you say to them, no way. There's no way I'm selling this bond for $10,000 because of all the current $10,000 bonds pay only $600 a year, and this one pays $8,000. This one must be worth more. How much more? We're actually going to be able to calculate that. But it's certainly worth more than $10,000. It's not worth $20,000. It's probably worth more than $11,000. But there is a correct number, and we need to learn how to calculate that number. And here's how we're going to calculate it. What does 800, 800, 800, 800, 800, 800 look like? If we remember back at the beginning of the semester when we did a lot of the time value of money calculations, this is an annuity. And we have $10,000 laid out here. That is a lump sum. So my bond with an 8% coupon pays me $800 every year until maturity, 30 years. And at 30 years, I get back my principal at $10,000. So I have to figure out this value. Now, when I'm valuing my bond, do I care what the interest rate was when I bought the bond? Or do I care what interest rates are right now? And the answer is right now. The only reason I care about this coupon interest rate is to calculate my interest. But if I'm going to value this bond, I want to know what the current interest rate environment is. So I'm going to take 800 times present value of an annuity. And our first example that we had, K equals 10, N equals 30. And we also get our lump sum back, $10,000 times present value of $1, because this is a one-time payment. K equals 10, N equals 30. One thing I know for sure, when interest rates go up, the value of bonds go down. When interest rates go down, the value of bonds go up. It is what is called an inverse relationship. So this looks kind of silly, but it's a lot like a teeter-totter, right? When interest rates go up, the value of my bonds are going to go down. When interest rates go down, the value of my bonds go up. So when I do this calculation, one thing I know for sure, because interest rates went up, my value has to be below $10,000. And so when I do my calculation, present value of an annuity, K equals 10, N equals 30, that factor is 9.4269. We multiply 800 times 9.4269, and we get 7,542. $10,000 times present value of $1, K equals 10, N equals 30. Our factor for that is 0.0573. And let me move this factor up over here so we don't get that confused, because we don't want to get too many numbers tied in. So we multiply 10,000 times 0.0573, or $573. We add those two together. One of the mistakes that a lot of people will make is they won't add the annuity and the lump sum payment together. We add these together, and we get a value of this bond of $8,114. So this bond sells at a discount of about $1,900, because this bond has a substandard rate of return, only $800 in a 10% rate environment. So it sells at that discount. Now let's go the exact opposite way. See how we're going to do that. So if interest rates don't go down, if interest rates go down instead of going up, let's say K equals 6. Since interest rates have gone down, I know my value has to be up. No matter what my answer is over here, it has to be above 10,000. If my answer is not above 10,000, I made an error somewhere. So 800 times present value of an annuity, K equals 6, N equals 3. That factor is 13.7648, giving us a dollar amount of $11,011. And we're going to add to that the lump sum. 10,000 times present value of $1, K equals 6, N equals 30. Our factor is 0.1741, which gets us $1,741 for a total value of $12,752. So this bond will sell at what we call a premium. A premium means it sells above face value. This has a $2,752 premium. The other bond that sold below $10,000 sold at a discount. Okay, One other point that we need to make here on bonds. So we got our same bond here, our 8% bond with a 10% face value, pays us $800 in interest every year, and we get back our $10,000 at maturity. We already calculated the value at n equals 30, and it sold at a discount of $8,114 if the current interest rate environment was 10%. Right? We know that this has to sell at a discount. Interest rates went up. Value of the bond must go down. So here's a question. As we shorten the term, as we go from n equals 30 years down to 20 years, what happens to the value of our bond? Does the value of our bond go up, or does the value of the bond go down? The value of our bond will actually go up. The reason the value goes up is, think about it. Our current interest rate environment is 10%. Our bond has a substandard rate of return of 8%. Do you want a substandard rate of return for 30 years? Or would you rather have a substandard rate of return for 20? Or would you rather have a substandard rate of return for 5? If you're getting a substandard rate of return, i.e. your bond is selling at a discount, the shorter the term, the higher the value. And so if we look at n equals 20, the 20-year bond, if we do all the math, I won't bore you with it, is $8,296. And if our bond has 5 years to maturity, it's worth $9,241. Because what we're doing is we're getting closer and closer to the 30 years, or closer and closer to the maturity, and we're going to get back our $10,000. The day it matures, our bond is worth $10,000. It doesn't matter if interest rates are 50% or they're 2%. On that day, it's worth $10,000. The exact opposite takes place if k equals 6. We calculated our value earlier here at $12,752. Now here's a question. All the current bonds are paying 6%. Our bond pays 8%. So that's like really cool. Would you rather have a superior rate of return for a long period of time, or a superior rate of return for a short period of time? Well, I certainly would rather have it for a long period of time, which tells me that as the periods get shorter and shorter, our values are going to come down. And if we solve this equation the way we did the other ones for n equals 20, 20 years from now, the bonds were $12,294. And if we only have 5 years to go on our bond, it's worth $10,843. All right. Bond valuations get very tricky. And so what you need to do now is you could go to page 17 in the supplemental materials, and it goes through how to calculate bonds. You turn the page there to 18, and you have 2 valuation questions. You have the first one is a $25,000 bond with a coupon rate of 10%. And then it gives you 3 interest rate environments in which you need to solve that. Then it's got another question below that, another bond with another 3 interest rate environments. It would behoove you very much to go through those pages and answer them. And if you have any questions, certainly contact me. Thank you.